Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another deep dive.
It should be a good one.
Today, we're breaking down a company that is often overlooked, really because of its simplicity. We're talking about Public Storage, ticker symbol PSA.
The invisible landlord.
Exactly. On the surface, it's a fantastic, durable business. But the real question for us as long-term investors is this. Is this seemingly simple model truly built to last for decades? Or are there hidden cracks in the fortress that the market is ignoring? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use interactive brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this business model because, like we said, it is deceptively simple. I mean, if I asked anyone on the street what Public Storage does, they'd just say they rent boxes.
And they wouldn't be wrong.
They wouldn't be wrong, but when we really drill down, what exactly is the revenue architecture that supports that massive, a $47 billion valuation?
Well, at its core, it really is a pure real estate play. But, and this is the crucial part, it has these operational and psychological twists that set it apart from owning, say, office buildings or apartments.
Right.
The primary revenue source, we're talking around 95% of it, very consistently, is pure rental income. They acquire land or sometimes existing facilities, they divide that space into those iconic metal boxes, and then they rent them out.
Almost always on a month-to-month basis, right?
Almost always. And that flexibility is actually a hidden structural lever for them, which I'm sure we'll get into later. It's not a benefit for the customer in the long run.
So the vast bulk of the cash flow is just generated by the metal box itself. But that remaining 5%, those high-margin ancillary streams, that's where the magic really happens, isn't it? That's what separates the dominant players from everyone else.
Absolutely. That 5% is critically high margin because it uses the existing physical footprint and the existing customer base without really incurring much additional capital expenditure.
So it's almost pure profit.
Very close to it.
Mm-hmm.
And it comes primarily from 3 distinct areas. First, you have tenant reinsurance, which they famously call the orange door insurance.
I've seen that.
It's often a mandatory add-on that covers the tenant's goods, but operationally, what it really is a highly profitable captive insurance business for PSA. They're underwriting minimal risk for a maximum margin.
And the tenant pretty much has to buy it, right?
Yeah.
Because you have to provide proof of insurance, and it's just easiest to tick the box and buy it from PSA on the spot.
Precisely. It's a convenience play that's also incredibly profitable. Then second, you have merchandise sales.
The locks and boxes.
The tangible items you need right then and there. High security disc locks, boxes, packing tape. You're already there. You need a lock. You buy their lock. It's simple.
Another high margin sale.
Exactly.
Yeah.
And finally, they engage in third-party management for smaller, maybe private facilities. They leverage their brand, their operating systems, and their marketing muscle for a fee. It's a highly synergistic, very asset-light revenue stream for them.
Okay, so we have this simple structure, but as you mentioned, its durability isn't just in the concrete. It's anchored by something much stronger. Human nature itself.
That is the entire fundamental thesis for investing in this sector. I mean, the whole business is built on a permanent, deeply structural human behavior known as loss aversion.
Right.
Psychologists like Kahneman and Tversky have shown we are fundamentally wired to feel the emotional pain of parting with possessions, of realizing a loss far more keenly than we feel the pleasure of acquiring new ones.
We prioritize avoiding pain over achieving gain. It's a fundamental bias.
It's the engine of this business. And critically, this psychological wiring is being reinforced by these huge macro societal trends.
Like urbanization.
Exactly. Continued urbanization pushes people into smaller and smaller living spaces, apartments, townhomes, houses with no basements or garages. Society as a whole is accumulating stuff, assets faster than our living spaces are expanding.
It creates a forced need for an external closet.
An enforced secular need. And that trend is highly likely to continue for the next 10, 20, even 30 years. It's a powerful, durable tailwind that's powered by psychology, not just by what the Fed is doing with interest rates.
And this leads us right into what I think is the most fascinating part of this whole thing. It's what Charlie Munger would have called a Lala-Palooza effect.
A textbook example.
It's a textbook example of multiple independent forces all combining and multiplying the outcome. It's not just one reason people keep a unit, it's a whole trifecta of interlocking psychological traps that basically locks the customer in.
That's a perfect way to put it. When you can successfully layer behavioral economics over a stable real estate asset, you generate an extraordinarily sticky, captive customer base. And that stickiness is the necessary prerequisite for the aggressive pricing that we're definitely going to talk about later.
So let's break it down. Force number one, psychological denial.
This is the initial self-deception. It's the story you tell yourself. When you first rent a storage unit, you almost always justify the expense by saying, oh, this is temporary.
Just for 3 months while I move, or while I renovate.
Or transition jobs. The initial commitment is so easy because the customer sees the time frame as short and the pain is fleeting. It's a small, manageable problem.
But the data tells a very different story.
The operational data shows this is almost never true. The average tenure for a storage unit isn't measured in months. It's often measured in years, far, far beyond that initial self-imposed deadline. So denial acts as this massive, subtle customer retention tool right from day one.
And that denial, it quickly compounds into the second force, which really hits the wallet. We're talking about the sunk cost fallacy. We're already wired not to throw away things we paid for, the original price of that old couch. But then you layer on the additional years-long cost of the storage rent itself.
And this is a devastating financial trap. It's brutal. Customers over time end up paying multiples, sometimes 5, 6, even 7 times an item's original purchase value just in cumulative storage rent.
For a piece of furniture that's now worth maybe $50?
Exactly. Yet they refuse to throw those items away because doing so would mean finally admitting that all the money they spend both on the item and on the accumulated storage fees was a complete waste.
It's admitting a mistake.
And the pain of realizing that sunk cost is psychologically so much higher than the pain of just paying that smaller, recurring monthly rent payment. It's a perfect behavioral trap.
And then there's the final lock-in, which is the physical manifestation of all this inertia. Force number 3, physical switching costs. This is where the simple act of leaving becomes prohibitively expensive and just a huge hassle.
Just think through the logistics required to defeat a competitor that's maybe $20 cheaper a month. To switch from PSA to a new facility, you, the customer, have to go rent a big U-Haul truck or a van.
Which isn't cheap.
It's not. You probably have to take an entire day off work, which has a cost. You have to convince a friend to help you or pay for expensive movers.
Then you have to load all those dusty, heavy, bulky items you haven't seen in 5 years.
Drive them across town and then unload them all at the new facility. That immense physical and emotional effort, just the sheer friction of it all, it completely transcends mild price sensitivity.
So even if a competitor offers a rate that's, say, $30 cheaper, the cost of the move, both financially and mentally, just makes staying in the existing unit feel cheap and convenient by comparison.
That's the crucial insight. It's that psychological friction and that physical inertia that translates directly into their financial moat. It's what allows them to do what very few other businesses can do successfully over long periods.
Which is?
Raise prices. These 3 combined factors, denial, sunk costs, and physical friction, give PSA incredible nonlinear pricing power. They can raise rates on existing customers significantly above the rate of inflation without triggering a mass exodus.
So their durability isn't really protected by the steel in the buildings.
No, it's protected by the inertia of the human mind.
So if psychology explains the structural need and that fundamental stickiness, then massive scale and technological sophistication, that explains their financial dominance in what is still, at its heart, a very local real estate business.
Absolutely.
Let's move into Section 2 and really examine how they translate that national scale into an unbeatable local competitive barrier.
Let's do it.
We've established that real estate is local. It's all driven by specific market needs, hyper-local supply and demand. So if that's true, how does a national company with a market cap over $47 billion create a competitive moat that just crushes local mom-and-pop operators? How does scale and data defeat the local entrepreneur?
The competitive barrier comes from leveraging that national scale to achieve these proprietary operational advantages in those localized markets. Local competitors simply cannot compete on two key, and they're very intertwined fronts: customer acquisition and data science.
Let's start with customer acquisition, the CAC.
Okay, PSA spends over $600 million annually
Wow.
on property operations and marketing.
$600 million. That's a staggering number just to get people to click the link and drive to the orange door.
It's an enormous recurring war chest dedicated simply to filling those units. And that budget allows them to completely dominate the digital on-ramp.
What do you mean by that?
If you go to Google and you type in "storage near me," which is the highest intent, highest value search term you can imagine.
The person typing that needs a unit now.
Right now. PSA's massive budget ensures they dominate the paid search results. They're at the top. They appear prominently in the local map packs. They're pushing all the smaller competitors down to page 2 of Google.
Which is where websites go to die.
Effectively, they don't exist. And because of their sheer volume of conversions, their marginal CAC is lower than any competitors. It means they own the digital highways, the on-ramps to the physical properties in almost every major metro area in the country.
And beyond that digital dominance, you have the physical moat, the irreplaceable asset moat, which is a structural advantage that time is only making stronger.
That's the location moat. And it's anchored firmly in, really, regulatory and political reality. PSA owns over 3,300 facilities. A huge portion of these hold premium, high-visibility locations.
The billboard assets.
We call them the billboard assets, right on major highways or primary commercial corridors. And these locations are almost impossible to replicate today because of increasingly stringent modern zoning restrictions.
We're talking about NIMBYism, not in my backyard.
Exactly.
Nobody wants a massive, plain, concrete box structure built next to their homes or in their nice new commercial centers.
Precisely. Municipalities today, they just rarely approve these massive, traffic-generating, architecturally, let's be honest, sterile storage box structures in prime commercial areas. PSA built its footprint decades ago when zoning was far, far looser. Their existing footprint is, for all intents and purposes, functionally irreplaceable.
Securing permanent high-traffic visibility and convenience.
Which is a critical part of that switching cost lever we talked about.
Okay, I see your point. The scale wins the digital battle online, and the legacy assets win the physical location battle on the ground. But here's where it gets really interesting for me, and where the data scientists kind of take over. Let's talk about their proprietary pricing engine, the system that weaponizes that physical switching cost we just discussed.
We have to talk about the ECRI system. That's the existing customer rate increase algorithm. This is the intellectual property. This is the secret sauce that maximizes their profits and is arguably the single most important margin driver they have.
So what is it doing?
PSA uses very sophisticated proprietary data, and it's derived from millions and millions of customer tenure and churn interactions over decades. And they use it to precisely calculate the maximum rent increase an existing tenant will tolerate before they decide the pain and the cost of moving finally outweigh the savings.
That sounds incredibly aggressive, but also, financially genius.
Yeah.
What kind of data points are feeding this algorithm to make such a precise calculation? It can't just be supply and demand.
No, it's not just simple demand data. The algorithm is constantly integrating these highly granular, hyper-local inputs. Think about it. They're monitoring things like local moving van rental prices in your zip code. Hyper-local employment data that might suggest a tenant is facing a job loss and can't afford to move. Local market pricing for new units, what they call the street rate, the specific tenure of that customer, how long they've been there, and even the seasonal weather pattern.
Weather.
Because you are far, far less likely to move a large unit in January in Chicago than you are in May in San Diego.
Wow. So they are timing the rate increase for the exact moment the customer is least willing or least able to incur that physical switching cost.
That is the entire goal. For example, the algorithm knows a customer who's been paying $150 a month for 18 months in a dense, cold climate market can probably handle a jump to $195 a month. That's a 30% hike.
And they won't churn.
They won't churn. That $45 increase is painful, yes, but the math reinforces the inertia. The $45 difference is significantly less than the $500 it's going to cost you to rent a truck, maybe hire some labor, and lose a full day of work.
So the ECRI system is just aggressively targeting the exact financial inflection point where that physical switching cost outweighs the price hike.
That's it. So the pricing isn't based on general market inflation or what a new customer would pay. It's based purely on the specific existing tenant's individual pain threshold and their personal switching cost profile.
It's a behavioral economics masterstroke applied directly to real estate.
It is, however, and we have to acknowledge this aggressive strategy, while it's highly effective financially, it generates significant friction. Significant.
How do we know that?
We can confirm this dynamic by analyzing external data sources, what we call scuttlebutt simulation, basically just looking at millions of customer reviews online.
And the reviews are often scathing, I imagine. But they actually confirm the thesis of high pricing power.
They absolutely confirm the pricing power, even as they highlight a major reputational challenge. If you examine customer sentiment, you see this visceral anger regarding what they perceive as bait-and-switch pricing tactics.
Right.
Customers frequently cite these low introductory rates, $1 for the first month or 50% off, and then that's followed very quickly, sometimes within just 3 to 6 months, by these non-negotiable rate hikes of 30, 40, even 50%.
Okay, here's where I want to introduce some critical friction into our own analysis. If that reputation for aggressive, high-friction pricing is so widespread, doesn't it eventually start to raise their customer acquisition cost? Doesn't it start to offset the gains from the ECRI system?
That's a fantastic question.
I mean, is there a tipping point where people just stop trusting the Orange Door brand altogether?
That is a fascinating and a crucial tension in the business model. And so far, the data suggests the answer is no, or at least the financial gain from the ECRI system far, far outweighs any reputational cost.
Why?
Because people are highly price sensitive when they start looking for storage. That's the initial CAC battle. But they are highly convenience and friction sensitive once their possessions are already locked inside a unit.
So the brand reputation is strong enough to get them in the door.
And the switching cost is strong enough to keep them there. However, your point is a good one. If a tech-forward competitor, a new startup, managed to maintain that low initial CAC while fostering a better long-term service reputation, that could indeed be a significant risk to their future retention rates. It's something to watch.
Okay, let's quickly look at the competitive landscape. We know PSA is the 800-pound gorilla, but who are the direct rivals? And how does PSA's model structurally differentiate itself, especially when you think about economic cycles?
The two main publicly traded direct competitors are Extra Space Storage, EXR, and CubeSmart, which is CUBE. And the primary structural differentiation between them really lies in the operational model. Are you asset-heavy or are you asset-light?
Explain that.
EXR, Extra Space, often follows a more asset-light model. They rely heavily on third-party management contracts, so they scale their brand and their operating systems for a fee, managing units that they don't actually own. PSA, on the other hand, is heavily asset-heavy. They own the vast majority of their facilities, they hold the real estate risk, and because of that, they capture all of the profit.
So if EXR scales by adding management fees, PSA scales by owning more and growing the net operating income, the NOI, from those owned assets.
Got it.
So what are the long-term implications of those two different models?
The implications are critical during cyclical shifts. The asset-light model, like EXR, means you have less cyclical exposure. You have more stable fee-based income during downturns, which is good. But you also cap your upside. You only capture a fraction of the NOI growth during the boom times.
And PSA.
The asset-heavy model means they take the full hit during economic downturns. Lower occupancy, lower street rates, that hurts them directly on the bottom line. But they capture 100% of the upside during the booms. This gives PSA significantly more operating and financial leverage when the cycle turns favorable.
So for an investor looking for leveraged exposure to an economic recovery, PSA is the superior choice.
I think so, yes.
And this asset-heavy approach, combined with their big technological push, seems to be widening the operational gap even further, especially against the smaller players.
It is. The implementation of their rental platform is a massive game changer. It's a huge deal. This system enables entirely unmanned move-ins.
So I could do everything on my phone.
A customer can rent the unit entirely online, get the gate code, get a digital key sent to their phone, and start moving their items in without ever interacting with a single human property manager.
This has to drastically reduce labor costs, which is one of the biggest line items in any real estate business.
It's massive. They reduce payroll, benefits, administrative overhead. This technology integration dramatically increases their margins relative to the smaller, traditional mom-and-pop operators who still rely on a person sitting at a desk during all business hours. It's an efficiency edge that only scale and a $500 million marketing budget can really afford.
So the business model is simple, but the execution, as we're seeing, requires immense financial muscle, technological sophistication, and crucially, very disciplined management.
That's right.
So let's transition into Section 3 and look at how they actually manage this fortress, particularly the strategic importance of that balance sheet.
Let's do it.
When we talk about real estate companies, the default mode for management is often just, being a passive landlord. You collect the rent checks. But the sources suggest a pretty major philosophical shift happened under the current leadership at PSA.
It really did.
So how has the CEO, Joe Russell, how has he modernized this formerly sort of sleepy giant?
Joe Russell, who took over as CEO back in 2019, fundamentally changed the company's operating philosophy. The shift was from being a passive real estate collector to being a highly efficient, tech-enabled operator who's completely obsessed with maximizing the yield on every single square foot of space.
Sweating the assets.
Exactly. His leadership is marked by this intense focus on digital transformation, implementing that ECRI system we talk about, and perhaps most importantly, religiously maintaining what they call a fortress balance sheet. The goal was to sweat the existing assets using technology rather than just, riding the wave of generic market growth.
Let's talk about incentives. How is management compensation structured to keep them focused on long-term shareholder value rather than just chasing short-term gains or empire building?
Management comp is tied directly to performance-based restricted stock units.
Yeah.
And specifically, those are pegged to total shareholder return, or TSR, relative to their peer group.
So EXR, CUBE, the ones we mentioned.
The ones we mentioned. This aligns management directly with long-term shareholder outcomes. However, as investors, you always have to monitor this for the risk of growth at any cost.
Right.
Especially growth through aggressive, high-priced acquisitions that might destroy shareholder value, even if they momentarily boost the size of the empire.
Which brings us to what I think is the ultimate rationality test of management quality. Capital allocation discipline during the most recent M&A cycle. Did they pass the test when their biggest competitor made a huge, splashy purchase?
They passed with flying colors. It was, I think, the defining moment of the last few years for them. The moment was their decision regarding Life Storage.
Okay.
PSA was heavily interested in acquiring the company. They wanted it. But when the bidding escalated, driven up by competitors, they famously demonstrated restraint and they just walked away from the deal.
And Extra Space ended up buying it instead.
Extra Space bought it. And that ability for PSA's management to sit on their hands, to prioritize price discipline over just pure empire building, that is an incredibly strong positive signal. It shows a deep commitment to capital preservation and rational deployment, even when you're faced with the pressure of a major acquisition slipping through your fingers.
And it confirms a profound commitment to long-term value.
It does. And that discipline ties directly into their whole approach during the ZRP era, the zero interest rate policy era. And this really defines them against many of their real estate peers who just leveraged up like crazy.
That's a critical distinction.
Yeah.
During ZRP, when money was basically free, a lot of real estate companies, a lot of REITs, justified leveraging their balance sheets up to 5 or even 6 times net debt to EBITDA just to juice their short-term return on equity.
And PSA actively avoided that trap. They deliberately accepted a lower short-term ROE and maintained significantly lower leverage. They made a trade.
They traded potential excess returns during the boom
for undeniable resilience during a downturn. And that decision proved incredibly prescient when interest rates spiked. Their peers now face massive refinancing risks and much higher interest burdens, while PSA remains relatively untouched. They chose survival and stability over short-term financial engineering.
So let's challenge that decision, playing devil's advocate here. Didn't that conservative approach mean they missed out on significant growth opportunities when credit was so cheap? Was that restraint actually optimal, or were they just lucky that inflation and interest rates came roaring back so aggressively?
That's a very fair challenge. And in hindsight, yes, they absolutely missed some short-term gains. But the optimality of their choice is revealed in the current high-rate environment we're in now.
How so?
Their low leverage, particularly that A credit rating they have, it grants them a massive multi-cycle strategic advantage. They have the optionality to remain stable now, while their highly levered peers might have to sell assets or raise capital at very unfavorable terms just to stay afloat.
So their restraint during ZRP wasn't just luck.
It was not just luck. It was a proactive strategy to weaponize their balance sheet for the inevitable cyclical turn.
Let's define that weapon then. What does this conservative financial approach really mean for their resilience? Let's talk about the balance sheet as the ultimate lethal weapon in a high-rate environment like this one.
It is the single most important competitive asset they possess right now. PSA maintains one of the only A credit ratings in the entire sector. Their key metric, net debt to EBITDA, is exceptionally low. It's hovering around 2.9 times.
And just for context, what are their peers at?
Compare that to those leveraged competitors who are often sitting at 5 or even 6 times leverage.
To help the listener understand, that 2.9x ratio is almost like a generational family business that rarely needs to take on external debt. Their competitors, at 5x or 6x, they're structured more like aggressive growth startups, highly dependent on cheap credit continuing forever.
That's a great analogy. And that difference becomes absolutely critical when credit markets tighten, which is exactly what we've seen over the last couple of years.
Right.
When interest rates are high and credit markets freeze up, those highly levered competitors, especially the private equity-backed players, they're forced to deal with refinancing risk and potentially distressed sales just to survive.
And that's when PSA can pounce.
That's when PSA, with its low leverage and pristine credit rating, can step in and play offense. They can acquire those distressed peers and those distressed assets at massive discounts. Their balance sheet is a strategic weapon for accretive expansion during economic downturns.
Now, let's quickly touch on the profitability metrics that result from all this.
Yeah.
The scale, the low-cost structure. The operating margins here are truly exceptional, especially when you remember this is a physical real estate business.
They are consistently the highest in the industry, which really speaks volumes about the efficiency of their technology and the strength of that ECRI pricing engine. We're talking gross margins that hover near 75%.
75%. I want to pause on that. To put that in perspective for you, that's a gross margin that is higher than many top-tier pure-play software companies. Yet this is a physical business made of concrete and steel. That is a staggering figure.
It is, and net income margins often exceed 40%. The combination of their digital dominance, which gives them a low CAC, their ability to aggressively push rents with ECRI, and their low operating costs from things like a rental and their solar initiatives, it all combines to create this highly, highly efficient profit machine.
And one of the most important takeaways for us as analysts is the quality of those earnings, specifically how their net income converts into free cash flow.
Yeah.
Why is the capital expenditure or CapEx structure so important in the self-storage business?
Maintenance CapEx is incredibly low. And it's low because the assets themselves are just highly durable concrete and steel boxes.
Right.
They don't need frequent replacement of highly aesthetic materials. They don't need new carpets every 5 years or updated appliances or frequent roof replacements like you see in apartment buildings or hotels. And because of this inherently low CapEx requirement, their net income very closely mirrors their free cash flow.
That, to me, is the definition of high-quality earnings. The paper profit that you see on the income statement actually hits the bank account as cold, hard cash that's available for dividends or for acquisitions.
Absolutely. And if we look at their return on invested capital, their ROIC, we see really impressive consistency. It's consistently around 11.6% over the trailing 12 months. And crucially, this consistently exceeds their cost of capital.
Which
means every single dollar they reinvest or spend on new development is actively creating value for shareholders. It's compounding capital rather than just treading water.
So we understand the quality of the business, the strength of the balance sheet, the genius of the pricing system. But the best business in the world can be a terrible investment if you pay too much for it.
Always.
So let's move into section 4, valuation, growth, and contrarian view.
Okay, so PSA is viewed by the market as the quintessential blue chip REIT. It's a lower volatility stock that often trades at a premium multiple, typically somewhere between 18 and 22 times price to FFO.
Price to funds from operations.
Right. And the market treats it almost like a bond proxy that just happens to have these reliable incremental growth kickers attached to it.
We need to pause there for a moment and clarify that core metric for the listener who might be more used to traditional PE ratios. Why do we use FFO for REITs, and what exactly is it?
That's a great point. It's really important. FFO, or funds from operations, is the primary metric we use for real estate investment trusts because traditional net income is distorted by these big non-cash charges that don't really reflect the operating reality of a real estate business.
You're talking about depreciation.
Specifically, FFO adds back depreciation.
And why is depreciation less relevant for a company that owns storage boxes?
Well, depreciation is an accounting estimate for the physical wearing out of an asset over time. But these steel and concrete structures, they have exceptionally long, useful lives and, as we just discussed, extremely low maintenance CapEx. So FFO gives you a much cleaner measure of the actual cash flow being generated by the operational performance of the properties before they hand that money over to shareholders. It is the real engine of the business.
So given that they always trade at a premium FFO multiple, where do you find the margin of safety? It certainly isn't found in just a dirt cheap valuation.
No, you're not going to get that. For PSA, the margin of safety is found not in a low PE or a low PFFO, but in the spread to sovereign yields.
The spread to government bonds.
Exactly. You are looking for a moment when the stock's total expected return, which we can roughly estimate as the current dividend yield plus its long-term sustainable growth rate, maybe 8 to 10%, significantly exceeds the risk-free rate.
Which we typically use the 10-year Treasury yield for.
The 10-year Treasury. If the stock's expected return only just matches the rate you can get on a guaranteed Treasury bond, then you're taking on all this unnecessary equity risk for no extra reward.
So the ideal buying window opens up when the market panics about some cyclical fear, offering us a chance to buy a long-term secular compounder at a temporary discount.
That's exactly it. The best entry point is usually a panic-selling moment caused by these temporary cyclical fears. Maybe there's a report about temporary oversupply in a few key markets, or a deep fear of recession leading to predictions of lower occupancy.
And the market overreacts.
The market tends to overreact to these short-term supply and demand dynamics, and it momentarily forgets about the decades-long secular growth story that's driven by loss aversion and inertia. If you can buy during that panic, you secure a favorable starting valuation, and you allow that powerful long-term growth story to compound from a much, much better base.
So what does the valuation look like today in the current reality?
At current valuations, which are roughly around $270 a share and sitting around 18 times FFO, the stock appears, I would say, fairly valued, maybe slightly premium, but it's not screamingly cheap.
So what does that mean for future returns?
It means that future returns are most likely to track the underlying business growth. So you're looking at maybe 8 to 10% annual returns rather than getting a tailwind from multiple expansion. And we have to be disciplined and acknowledge that historically, buying PSA above 22 times FFO has often resulted in what investors call dead money for years, as the stock simply grows into its already inflated valuation.
Okay, let's shift to growth then. Where does a company this large, this mature, find its next leg of expansion? It's not sustainable to rely solely on massive new construction, especially given those zoning restrictions we talked about.
The primary, most reliable growth engine is still the consolidation of mom-and-pop operators.
Really? Still?
The U.S. storage market remains surprisingly fragmented. I mean, about 40 to 50% of the total market capacity is still non-right earned. It's managed inefficiently, it's under-marketed, or it's priced suboptimally.
That's a huge, inefficient, addressable market for PSA to bring their technology and scale to bear on.
It is the ultimate opportunity. PSA can acquire these inefficient, often family-run, undermanaged assets, and they can plug them immediately into their superior national marketing engine, that $600 million war chest.
And apply the ECRI system.
And critically, apply their proprietary ECRI pricing system. They can instantly lift the net operating income, the NOI, by 30% or more simply by optimizing the operation and the pricing structure. This is capital allocation alchemy. You're buying $1 of inefficient cash flow and turning it into $1.30 of highly efficient cash flow.
That operational arbitrage is a powerful driver. Now let's look at the dark side. What are the biggest, most permanent risks to this entire thesis? I'm talking about risks that could permanently impair the business model, not just cyclical dips.
There are two main risks, and they're both tied to the physical real estate and the competitive environment. First is the zoning and supply shock.
Okay.
The entire pricing power structure relies on those stringent zoning rules that prevent easy, cheap, competitive supply from being built. If municipalities, maybe they're struggling with budget issues after a downturn, if they relax those stringent zoning laws or streamline their permitting processes, then cheaper land on the periphery of metro areas could be rapidly developed into new supply.
And massive oversupply, which is commoditize the service and completely crush PSA's hard-won pricing power.
It would completely undermine the physical switching cost moat. The second major risk is what I'd call the property tax spiral. If municipalities continue to struggle financially, commercial real estate is always an easy, visible target for revenue generation. Aggressive, sustained property tax hikes directly hit net operating income. Real estate is inherently a high fixed cost business. You can't just easily cut your property taxes.
So those costs have to be managed or passed on.
And if both supply increases and taxes rise rapidly at the same time, that highly efficient profit machine we talked about begins to sputter very quickly.
Looking forward, we have to balance those risks with potential catalysts. What are the positive operational catalysts that could maybe surprise the market to the upside?
The most immediate catalyst is probably the de-anchoring of street rates. For the last few years, housing turnover was basically frozen because of high interest rates.
Right.
And that led to softer street rates, which are the prices they charge to new customers. If housing activity stabilizes and turnover accelerates, maybe because rates come down or just because people finally decide they have to move, PSA can aggressively raise those new customer prices, and that pulls the entire pricing structure upward with it.
Because new demand justifies higher street rates, which then eventually allows the ECRI algorithm to raise existing customer rates even higher.
Precisely. And there's a second sort of silent operational catalyst that's tied to sustainability, and that's the rollout of massive solar installations on their millions and millions of square feet of roof space.
That's a lot of empty roof space.
A vast, otherwise dead space. Using that for solar power could materially lower their operating expenses because electricity is a major cost driver for operating and lighting these huge buildings. Improving NOI margins by lowering OPEX is just as financially valuable as raising prices.
Let's address the consensus view we hear so often these days. Self-storage is dead because housing activity is frozen. People aren't moving, so they don't need storage.
What's the powerful contrarian perspective here that the market seems to be missing?
The market consensus is just too simplistic. It focuses only on the cyclical movement of home sales. The counter-argument is based on what we call the 3Ds: death, divorce, and dislocation.
The constants of life.
These events happen constantly, regardless of what interest rates or the housing market cycle are doing, and they create a steady baseline of demand. But more importantly, consider the people who are trapped in their smaller homes.
Okay.
Those who have outgrown their space but are unable to sell their current house and upsell to a larger one because of high interest rates and high prices.
So they need storage more, not less, because they are stuck and they can't solve their space problem by moving.
Exactly. The market completely ignores the powerful clutter accumulation factor of a stagnant housing market. If you are stuck in a house for 5 extra years that you've already outgrown, your accumulation of goods doesn't stop. In fact, it probably accelerates. You simply need an external closet for longer.
So the lack of housing mobility can actually reinforce the demand for storage.
It can extend customer tenure and increase the effectiveness of the ECRI system. It's a very powerful counter-cyclical force that most people miss.
This brings us to the final challenge, the red team inversion. We've established the thesis is strong, but what is the ultimate existential threat, the Kodak warning, that could fundamentally break the public storage business model and render their assets nearly worthless?
The ultimate risk is a structural decline in the need for physical storage that's driven by profound cultural shifts. We're talking about the convergence of the minimalism trend and the complete digitization of all media, photos, and documents. So the core thesis, loss aversion and clutter accumulation, that rests entirely on the human habit of hoarding physical things.
It does. And if the younger generations, if they truly begin to value experiences over things, and if that habit of hoarding physical items breaks on a generational scale,
then PSA is left with millions and millions of square feet of concrete, highly specialized real estate that has almost zero alternative use.
Zero. You cannot easily convert a storage box facility into an apartment building or an office park. And unlike necessity businesses, a storage unit is a discretionary luxury. In a deep, prolonged economic depression where household spending collapses and people are forced to liquidate their assets, occupancy could plummet to, say, 70%.
And because of that high operating leverage, the fixed cost of the building and the property taxes, low occupancy is catastrophic for the bottom line.
It would shatter the operating leverage entirely, it would wipe out margins and cash flow, and the stock price would absolutely follow suit. The key difference remains. This is a discretionary luxury that thrives when people have disposable income and a high willingness to hold onto their possessions. That distinction matters profoundly in a protracted economic downturn or a major cultural shift away from materialism.
So what does this all mean for us, the learner?
We have thoroughly analyzed a high-quality, durable business built on the timeless inefficiency of human psychology, loss aversion, and inertia, and it's protected by a fortress balance sheet and advanced proprietary pricing technology. The business model is simple, but the execution and the financial engineering are, well, they're extraordinarily sophisticated.
The business quality, the profitability, and the durability are, I think, undeniable. The primary challenge for you as an investor remains valuation. You have to pay the right price, you have to monitor that balance sheet discipline, and you have to constantly monitor for those existential threats we just discussed, particularly a supply shock and that pervasive generational cultural minimalism. The durability of public storage ultimately relies on one fundamental, enduring question. Will people ever stop valuing the things they already own, even when the cost of storing them exceeds their actual value?
The behavioral evidence, both historically and currently, suggests this human tendency toward accumulation and loss aversion is deeply, deeply entrenched. That psychological barrier is the most powerful competitive moat of all.
We analyzed how public storage uses proprietary data, the ECRI algorithm, to determine exactly how much they can raise your rent before you move your stuff out. But what if the next generation of self-storage companies finds a way to use AI, not to raise prices, but to predict what you should throw away? Would a data-driven subscription service that actively helps you declutter challenge the very foundation of the storage industry? Would convenience finally meet inertia? Something to mull over as you look around your own home. Thanks for joining us for the deep dive.